Alrighty, well, hello. Welcome to another episode of Equity Mates. This is a podcast where we explore what is possible in the world of investing. And if you've just joined us for the very first time ever, if this is the first time you've ever heard us or listened to us, my name is Bryce. And as always, I'm with my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this. How could I not be? Normally, we sit in a dark room, look in each other's eyes and talk stocks. Today, we get to do it in front of real people. So, a bit nervous, but I think we'll be all right. Today, we're going to talk about building wealth in stocks and property. We get tagged as anti-property all the time. We're not. We think you can whatever you want to invest in, as long as you're investing, that is good. And that's the message we want to leave you with today. As well as for people who are new to Equity Mates, pull out your phone, subscribe to our email, our podcast, our YouTube. Wherever you are, we are as well.
We're on a mission to actually plug our AI headlines podcast. So if you're not listening to that, get it out and have a listen. Daily news headlines.
No subtlety here.
No subtlety here. No subtlety. Anyway, tonight, as Ren said, property and stocks, we're going to break it into 4 sections. The first section, Ren and I are going to go through the key principles for long-term investing. We have then got a number of people in the community who have submitted their portfolios, and we're going to do a Pimp My Portfolio for each of them. So thank you to everyone who has submitted. We then will have Sam Gordon come up and talk us through all things rentvesting. And then we're going to close out with deal or no deal. We're going to put some properties up for Sam to say whether they're a deal or not. We've got some stocks from the Melbourne people last night, some portfolios to say whether they're a deal or not, and then we'll close out with some Q&A. So packed night.
Now, we want to say a massive thank you to Sam and the team at Australian Property Scout for helping us put on this event and helping us keep all of our content free here at Equity Mates. So you'll hear from Sam later, but a massive thank you to him and the team.
Now, you're probably wondering why we've done the event here in this awesome venue, the Fortress. Ren and I aren't necessarily gamers ourselves, but it does relate to investing in some way. And that is because the thematic of esports and video games has been hot in FY25. So much so that one of the best performing ETFs over the last 12 months is the BetaShares Game, up about 90%. So there's some portfolios that have game in it. Congratulations to you guys, but absolutely a thematic that is sort of top of mind for the Equity Mates community.
All right, well, let's get into it. You got the clicker?
I have a lot of things in my hand.
Most important part of the night. We don't know your personal circumstances. Anything we say is general advice only. Seek professional help if you would like it. We are licensed, but yeah, general advice only. Now that we got the important bit out of the way, let's get into it. We wanted to talk about property and shares tonight because we think one of the biggest shames in financial media here in Australia is how property and stocks are pitted against each other. It's one or the other. The financial media loves a choice. I mean, part of the reason is half of Australian financial media is owned by or supported by real estate portals, but that's another story.
Let's not go there.
But you can see here, you go on Reddit and it's property or shares, property or shares, property or shares. And, everywhere else it's the same. We're here to say that there's a time for both. And importantly, it's not a question of if, but when.
Give us a yell if you're here and you are solely property.
Nice.
Yeah, no one is going to do it. We're at a stocks event.
No one's brave enough.
Well played. Well, oh yes, one person. Congratulations. Thank you. 2, 3. Okay, now they come out the woodwork.
Here we go.
Come on. We've got Sam here. It's fine to say property.
All right. What about the flip side? Who's only stocks here? Okay.
Good mix.
What about only crypto?
Nice.
Okay.
What are you doing here?
Only fixed income and bonds?
Where are the oldies?
As we said, we're not here to say one or the other. Despite our reputation, we're not anti-property. We're here to say...
We were anti-property until we bought properties.
And now we love it.
now we love it.
Now may the pump
Cut interest
continue.
rates. Let's do it.
Is this reference dated? We were debating this earlier. Like, is this us showing our age or do people get it? Nice. Great. Phew. So I said earlier, it's not about if, but when. And I think the great thing about investing in Australia is I was about to say it's never become more accessible. Some asset classes, like stocks, have never become more accessible. Property, never been more inaccessible. But, Sam's got a strategy, but I'll let him talk about it. But I think the great thing about where you're starting out when you've got a low balance and you're just trying to figure it out, stocks have never been more accessible. There was a world not too long ago when we started investing where it was a $500 minimum to invest. The cheapest brokerage was $20 per trade with ComSec, and your choices were pretty limited. It was Australia and that's about it. And in the last 10 years, it's absolutely changed. You can now invest from 1 cent, and you can use platforms with zero brokerage. So starting with stocks, building your wealth, understanding how this whole world works, it's never been easier to get started. So for all those people who've been dragged here today by a friend or a partner, first of all, thank you. And secondly, it has never been easier to get started.
No, and I think our journey is, I think, a representation of maybe what a lot of you are going through as well, which is hopefully starting in stocks and then eventually getting to a point where property becomes a little bit more realistic over time. And, property is obviously an emotional decision. It's something that is inherent in the way we think about retirement and planning. And so naturally you want to start gravitating towards that. And as we said tonight, Sam's going to talk us through how you can not necessarily focus on buying principal place of residence first, but start actually investing in property and taking advantage of the system really, and a lot of the ways in which I think property can be good long-term investment alongside stocks.
Yeah, and then eventually it becomes a question of not one or the other, but both. And I think what we've learned over this journey is using both, as well as other assets, is a real 1 + 1 = 3 situation. There are a bunch of strategies where you can maximize the power of your investing, the amount of money that you have to invest, and your after-tax returns if you don't silo yourself to one asset class. So yeah, don't feel like you have to choose property or stocks. When you're investing in an asset class, you don't have to be value or growth. You don't have to choose. You can do a bit of everything. There's plenty of ways to make money as an investor. Let's learn from them all. That's what tonight's about. That's what Equity Mates is about. So let's embrace that.
So for those new to investing, for those that have been investing for a while, and for those that are, I guess, a single asset classes, we believe that there are principles to good long-term investing that apply to any asset. Potentially not crypto, but any asset. So the first is...
I reckon even crypto to an extent.
Really?
We'll get there.
Buy a quality asset? Anyway, we'll get there. So the first is start early and think long-term. Let compounding do its thing. And I think this is our biggest lesson, and I'm sure many people in this room would agree. The stats show the earlier you get into the market, obviously the longer you can let compounding do its thing. The challenge is, and we talk about this to a lot of groups around Australia, is that there's a real cognitive bias when it comes to understanding the real impact of, or understanding exponential growth. And when you think about, putting money away for superannuation, putting money away now when you're in your 20s for when you're going to be 40, 50, it's really hard to comprehend the impact that compounding is going to have over that period. So this is probably the biggest principle for us, starting early and getting your money in, because compounding is the most powerful long-term effect.
The best example of this, and it's not the last time we're going to mention him tonight, Warren Buffett, his life is an example of this. All of his best investing days were when he was young. He was, doubling his money in a year, 50% in a year, 100% in a year. He was crushing the market early days. But 99% of his wealth came after the age of 50. And his returns were lower, but it was just a consistent grind upwards. And if you're getting 20% a year every year, your money can really start to snowball. But it can only start to snowball if you're starting early and building that nest egg early. So start early, even if you don't think it's enough, it will grow over time.
And that flows into principle number 2, which is invest regularly. I think everyone in this room would be doing dollar cost averaging in some way through their superannuation, putting money in at a regular cadence for 40 or 50 years, your entire working life. That is investing regularly and is probably one of the most powerful principles that goes into starting early. I mean, we invest when we're paid and we automate that process. The more you can automate the process, the more emotion you take out of it. There is real power in getting money in as quickly and as often as possible.
Yeah, and the structure of a mortgage forces people to be regularly putting money away to that asset, and Australians will give up every hobby they have before they stop paying their mortgage. And so it forces people to, consistently put money away. If you don't have a mortgage, still try and have that discipline and consistently put money to work.
Number 3, buy high quality assets. So, this is, again, Buffett is a very good example of that, buying assets that he's going to be happy sitting on for 10 or 20 years. Like we talk about property, buying high quality property. It goes without saying, you don't want to be buying shit.
Yeah, well, this is, crypto, buy Bitcoin, not Fartcoin.
Fartcoin's done really well.
High quality assets applies in every situation. The flip side of buying high quality assets is thinking about valuation. There's a lot of investors that have bought high quality assets and then not made any money. There's been periods in Sydney where the property market has done nothing for 10 years and people have bought high quality assets and not made any money. But there's heaps of examples in the stock market as well. A generation of investors would have bought Microsoft in the early 2000s, and it's one of the best businesses that have existed, but took 20 years for them to actually make any money on it if they held it. So just a reminder that buying quality, but thinking about how much you're paying for that quality as well.
And then finally, think about after tax, after free returns.
After fee.
Sorry. Nothing's free.
Yeah. One of our 3 policies here at Equity Mates is we hate fees. And I think the great thing is that fees have come a long way down. So make sure you know what you're paying and don't overpay. All right, so those are the principles that we think transcend any investing class. Or any asset class. That's the general point. Now we're going to get into the stock portion. We're going to look at some portfolios and then we'll get to the property part afterwards. For people who listen to Equity Mates, they may be familiar with Pimp My Portfolio, where listeners submit their portfolios and get them reviewed by an expert. They hope that expert isn't Luke Larrative. We don't have Luke here today, thankfully, so it's just going to be Bryce and I reviewing these portfolios. But before we do, we just wanted to, set the scene. What does a great portfolio look like? We know there's plenty of people here who may be new to investing, and so before we actually look at some examples, we wanted to talk generally about how we would assess a good portfolio. And it really starts with there's no one right answer. It depends on your temperament, your goals, your time horizon, but we think there are some features that every great portfolio will have.
The first one is very clear and obvious, which is diversification. Not just diversification among asset classes, but across industries, geographies, you name it. The stats show the implications that diversification can have on your portfolio. We talk about the core and strategy, core and satellite, which we'll get to in a moment, but obviously diversification, number 1.
Sensible portfolio construction, not having too much money in any one stock, in any one ETF, in any one property, although that's hard these days, especially in Sydney. But I think thinking about where your money is and where the risk is associated with that. High quality assets we've already spoken about. Low costs and low fees we've already spoken about. And then finally, keeping it simple enough that you can get on with your life. You can set it up, hopefully automate it, and then do something more interesting with your days.
So you might be sitting there thinking, well, how does that actually translate into action? What can we do to build a portfolio that has all of those elements in it? And there are kind of 4 ways in which we think about building that portfolio. The first is probably the most simple, to your point, Ren. If you want to just invest and get on with your life, it's the all-in-one ETF. These are ETFs that are pre-made with underlying ETFs that give you global exposure, pre-made asset diversification and allocation, and all you need to be doing is consistently investing in them over a long period of time. It's for people who just want to be putting their money in the market and be done with it.
Yeah, so you can read these other examples, but I think for people who are new to investing and wondering where to start, write those 2 codes down. There are more out there, but do your research on products like that. Start buying that. Figure out how this whole world works, and then you can go from there. All right, let's get to the good stuff. Let's get to real portfolios. Thank you to those who submitted. Bryce, you're going to play Luke Larrative in this scenario.
I have hair, though.
We said no bald jokes.
Sorry.
All right, let's get into it. Thank you, Ayden. Is he here? Ayden, thank you for submitting the portfolio.
Front row as well.
Love that.
Love that. All right, well, I think on the previous slide we spoke about, there was a section there that spoke about the core and satellite approach, which is dividing your portfolio into a core element, which is broad diversified index funds, and then having a component that is trying to beat the market or has some sort of like growth or thematic or active tilt to it. Ayden, I think this is what you're trying to do here. You've got you've got great global diversification through Vanguard US Total Shares. You've got Aussie Ethical there. A bunch of beta shares thematics, Asia Tech, Aussie, and then a bit of sustainability as well. So I think in terms of diversification and asset mix, it looks pretty decent. Then we go into your what we would call your satellites. So you've got your Singular Health Macquarie Group, which has been a relatively strong stock over the last sort of decade or so, and then you're into Bitcoin. I think you're obviously loving Bitcoin, 12% allocation.
12% in Bitcoin?
Yeah, you've either got in early and it's run, up about 100%, exactly. The only thing here, you're either keeping cash on the side, 8% for whatever might come, or you don't know what you're going to be doing with it. But I think a cash allocation of that amount, you probably wouldn't want to go any higher. General advice only, my opinion.
I think we said one of the principles was thinking about your position size and how much money you have in different things. We spoke earlier about how esports has been a great thematic. This nerd ETF has done well, but you've only had 1% of your money in it. You know, that's a classic example where you're right, but if you don't have enough invested in it, then you don't get the rewards for being right. So I'd think about some of the smaller position sizes and either beef them up or chuck them out. But well done, Ayden. Love to see a core and satellite approach. Let's go to Courtney. Courtney, are you brave enough to tell us where you are? Oh, front row. Love that, Courtney.
What do you reckon? What do you reckon? This is yours? I hope so.
Yeah, it's mine.
Nice, good. So I think, again, Courtney here, 80-20 is what we're seeing here with a core and satellite approach. I think the call out, great diversification again globally. You've got international shares there, you've got US total market, you've got some gearing in there as well, NASDAQ. I would suggest though that with DHHF in there, that is one of the ETFs that we were talking about before, which is your all-in-one. You could almost simplify that entire core position into just DHHF, for example, rather than having a lot of overlap that is going on there between geared, between NASDAQ 100, between the S&P 500. A lot of those ETFs have very similar underlying sort of top 10, 20 companies. So I'm not sure how you went about creating that, but DHHF could be an all-in-one. In terms of the individuals though, a lot of great stuff in there. Soundhound is an interesting one, up 254% last 12 months.
Well done.
Solid. And BrainChip, on the other hand, bit of an AI theme here, down 22% last 12 months, but AI coming through there. Argo is a listed investment company, MMF, listed investment companies. I think just be cautious of those, but I think overall 80-20, good core split.
Nice one. He's much nicer than Luke Larrative, we will say. All right, Danny. Is Danny in?
Nice.
Danny, love that.
Danny.
Front row as well. A portfolio full of ETFs. Where do you start here, Bryce?
Yeah, loves an ETF. Nothing wrong with that. Nothing wrong with that. Again, we're seeing, strong core here with S&P 500, 20%. The beta shares diversified, all growth. Similar to Courtney though, if you wanted to really simplify this and make the whole experience a lot easier, DHHF could really replace a whole lot of those other, underlying indexes if you didn't want to take control of it yourself.
I mean, to illustrate that point, so we've got IVV and NDQ and then U100, which are all dominated by the US mega cap stocks, but then also the Vanguard International Shares ETF is dominated by the US mega cap stocks. So there's a bit of overlap there, which is fine if you want it, but you could reduce the complexity. Fair.
Yeah.
We don't know your tax positions. That's why we say.
We actually know nothing about you, so except your name.
That is important to keep reminding everyone. I will say, first, we've done, I don't know how many Pimp My Portfolios over the journey. I haven't seen the Australian financial sector's ETF.
Loves a bank.
So
Loves a bank.
You love Aussie banks? Yeah, fair enough. Commonwealth Bank has been on a run. Good to see that in there. Yeah, no, I think you can simplify it, but yeah, obviously you've got tax considerations.
I think something though that we've spoken to a number of experts about in that situation where you might have some stocks that you've got capital gains on and you don't want to cop it, depending on where you are in your journey, a lot of people sort of face this, particularly when ETFs like DHHF come out and you've already sort of started building your own core with individual ETFs. What do? I mean, one option is just cop the capital gains to get the portfolio set that is right for you now, knowing that it's going to be the best sort of long-term approach. But yeah, something to think about.
Think about generally, I think we should say.
Generally,
all right, we did a full ETF portfolio. Let's go to the other end of the spectrum, a highly concentrated, predominantly stocks portfolio.
Yeah.
Where are you going to go here, Bryce?
It has punter written all over it. Where's Taylor? Taylor? Yeah, he's up the back, right up the back. Nice.
Now, we laugh, but we actually had a look at some of these stocks, well, particularly Taylor's biggest individual stock holding, and our laughter turned to envy when we saw that smart parking has almost 10-bagged over the past 5 years. So,
yeah. And it is what it says. It's technology involved in parking lots, right?
So
yeah, that's exactly what it is.
So it's a lesson that good investing doesn't have to be sexy AI stocks. Sometimes it can just be parking technology.
But I think just to close this out, obviously very concentrated. There's nothing wrong with that. If you have high conviction in your stocks, then nothing wrong with building a portfolio like this. Taylor does have an ETF there, the QQQ, which is NASDAQ, 26% in US tech, but otherwise, yeah, highly concentrated.
I mean, Bryce says there's nothing wrong with it. I would say there is something wrong with it, just from a risk point of view, Taylor and everyone. It's, you know, if smart parking, it's been on a run, but let's say some new quantum computing parking technology comes out and smart parking halves in value, you've wiped 10% of the value of your portfolio. So I would just think about risk in those position sizes. We are the index boys. We do love an index ETF, but maybe build some diversification that way. All right, so those were the 4 portfolios. I think that's all we have. So thank you for those.
No, there's one more.
God.
Yeah. Yeah, this guy, Matt, who I think has dobbed in his dad's portfolio. Here he is, and his dad's here. Yeah. Now, Matt's dad loves tech.
Hold on. Can we just clarify? Matt's dad, we don't actually know your name, sorry. Did you know your portfolio was being submitted? Okay, all right.
Yeah, nice. So, Jules, great, obviously you love US tech, and Zero, I think, is in there, and a bit of BYD, less than 1%, but obviously all US tech. Now, I think if we go back to the principles that we spoke about before around diversification, and you are so highly connected and exposed to what goes on in US tech, I have seen the portfolio performance though, and I know you've almost 20-bagged Meta. So I understand that's why it's at 38% of the portfolio.
Yeah, so Jules, we're actually going to leave the stage and you're going to come up and speak to everyone.
You've also done incredibly well on Google. So obviously that's why it makes up over more than half of your portfolio. But I think genuinely, if you were to Ren's point, if anything happens in US tech, that can be wiped pretty quickly, and you might be left thinking, where do I go from here? So having some sort of, I guess, global exposure that's beyond just US tech would be where I would be going next. But yeah, can't complain with almost 20 bagging.
I think there's a lesson in 20 bagging Meta, making almost 20 times your money in Meta. You would have ridden some pretty tough times for Meta over the journey. There would have been, I'm not sure when exactly you bought it, but, the Trump election and Cambridge Analytica, and then the recent, interest rate rises and tech selling off, Meta changing its name to Meta, and Zuckerberg believing in the metaverse. It was down, more than 50% from memory? I think there's a lesson that we can all take from this, that if you're going to buy individual stocks and you want to make big gains on Meta or SmartPay, you've got to be willing to ride out the good times and the bad times. It's not all coming and getting a shout out at an Equity Mates live show.
So I think listen to Matt, who emailed and said he's been hounding you about low-cost index ETFs. Or maybe Matt, you should listen to your dad, actually.
All right, I think that was the last one.
That's it.
All right, now we reviewed people's portfolios, but we're not just standing here and not sharing our own portfolios. This is one of the shameless plugs that we do throughout the night. If you want to see what is in our portfolios on Equity Mates Investing podcast, we recently shared everything in our core satellite portfolios. So you can see what we own, and everything we produce is also on YouTube. So check out the Equity Mates YouTube channel to see what we own.
Love it. Well, that brings us to the end of our first section. We will now bring on Sam Gordon, who, as we said, is sponsoring tonight and has been a long-term partner of Equity Mates, and we do really thank him for the work he's doing. I know there are a lot of people in this room as well who are working with Sam, so we appreciate you guys coming along as well. And yeah, let's get into it. If we can welcome up Sam.
G'day guys, how are we all? Good stuff. I hear some APS clients in the crowd. Who we got? Oh, there we go. Got a few. G'day mates, beautiful. Good to see you all in the hometown of Sydney today as well, guys. So pretty excited to get up here today and talk in front of all of you. It's funny, what kicked off was like an initial podcast with the Equity Mates boys around rentvesting seems to have turned into a very common topic that we always seem to talk about, and something that I think is becoming more and more prevalent in the investing world, especially when it comes to property as well. So it's I think it's super prudent to kind of consider it, especially in a city like Sydney. It was similar in Melbourne last night. We're having a chat. Whilst Melbourne prices aren't anywhere near the level that our great city is, their yields are absolutely average. So it was a really good city to kind of drill into it on. But I think Sydney is probably the number one city to really talk about rentvesting and running through that as a model. I'm actually curious, how many people in the room rentvest? Beautiful. All right, awesome. How many people own their own home? Okay, shit, heaps here. And how many people don't own their own home? Okay, awesome. Sweet. Beautiful. It's pretty much an even split across the board. Now, there's a bunch of reasons to kind of run through why rentvesting is a really powerful strategy, and in my opinion is actually the most powerful, one of the most, if not the most powerful strategy in building a portfolio. And the biggest reason for it is because your primary residence is actually the biggest anchor to growing a large property portfolio. It's the largest debt you'll probably ever take on, and you take it on your personal name, and it brings in no income. So it absolutely obliterates your borrowing capacity, and almost everyone borrows their absolute maximum that they can for their primary residence, again, killing borrowing and killing the ability to build your portfolio. So hence why we're going to run through rentvesting and why it is such a powerful strategy. And so kicking off, guys, why did I rent so long? So this is one of the biggest questions that I always get asked is, Sammy, if you've got such a big portfolio, and not to brag, I've been doing this thing for 16 years. I've got 130 odd properties. I only just recently bought my own primary residence. But everyone always used to hit me up and say, Sammy, if you actually own so many properties, if you're so good at it, why don't you own your own primary residence? And I did for a while. I bought my first property at 19 and I owned my own primary residence until I was 27. And I literally hit a cap in servicing. I pulled every lever that I could and I was completely stuck. And the only thing that there was left to do was to actually move out of my own house and no longer live in my own home and rent it. And when I changed that strategy, I went from 15 properties, and in 12 months, I went to 26. I bought 11 properties in 12 months. I unlocked a lot of things when it came to creative lending as well. But when you combine that with creative lending and really understanding how to really push the needle, move the needle from that front, this can have, literally, like I said, such a massive impact, because the banks don't look at your own home as an asset. They look at it like as a liability, because it does not bring in income. Massive debt, no income, liability to the banks. So I'm going to break down all this, and probably the biggest point to note, guys, is once you know how to properly repurpose and redistribute debt, the game around lending in property can be limitless. I know the boys obviously love everything to do with stocks and shares, but the biggest thing that I love about property, you got $100,000, you're not getting a 7%, 10% return, whatever it is on the $100,000. If you leverage that into a $500,000 asset and you get that 10% growth, you're getting a $50,000 return on the $100,000 you invest into it. So the return from a leverage perspective is exceptional. And when you learn how to properly repurpose, redistribute debt, you'll realize why the primary residence is when you can clip that or get rid of that out of the equation, it is so powerful when you know how to really multiply that to a massive extent. Two biggest reasons you shouldn't own your primary residence early or at any, I won't say at any stage. In my opinion, you should only buy your primary residence when you can afford to buy your actual dream home. And once you finish building out a passive income portfolio. So if you're looking to build a property portfolio, my honest recommendation, the brutal truth of it is you want to build out the property portfolio first that's going to produce the passive income that you want to generate before you even consider the primary residence. Again, we go back to the simple point is it is the biggest anchor you will require in your journey. So if you can't afford to live in what you ultimately want, so the dream home, if you can't afford that yet, and you're wanting to build a property portfolio, build the portfolio first, come back to the house, to the dream home at the very end. Otherwise, it will take twice as long to build the portfolio if you'll ever even get there. Yeah, so like one of the biggest things with trading the primary residence is I call it bunny hopping. So every time you jump to a different asset type, and this is what we're going to run through, most people start, right? They start first home, 750 grand. Next deal might be 1.2 mil. Then you might get the 1.2, 1.8, 5, 7 years later. And then again, you might go to 2.5 mil. And what you find is every time you enter, and I'll run through this, but every time you enter a new property, you've got stamp duties on the way in and you've got exit costs on the way out. The cost of that is you cannot get that money back. And if you're in mortgage insurance territory, you also can't get that money back. We'll run through how expensive it is as you go through here, but it's an expensive transaction every time you do it. So now, guys, we're going to run through some examples in different areas here you might be looking at. Now, we're going to talk for the first value of this property, like I was saying, most people in Sydney, most young home buyers, all the rest of it, you might be looking at something like a 750 grand unit. I was having a bit of a look around the other day, talking maybe a nice unit in, say, Parramatta, Wollongong, something like that. You're not going to get much for that in, say, Cronulla or anything like that. You might be going further out. I was even looking out so I grew up in the Southern Highlands, and I used to catch a train into Fairfield every day. 2 trains and a bus every day in there, and I used to go through like Campbelltown, Lamia, all the way through into Fairfield and everything. You can't even buy a house in Campbelltown anymore for 750 grand. They're like $1 million. Mount Druitt, $1 million. $1 million to live in Mount Druitt. Are you kidding me? Like we were looking at the other day when we were pulling it together, and I thought surely we'll get a house in the Druitt for 750 grand. It was like 1.2 mil. It was blowing my mind. So anyway, 750 grand, full bottom end of Sydney, right? If you're saving your 20% deposit, you've got 150 grand to get in that deal. Your stamp duty is 42,000, legals, building a pest strata report, all your costs on the way in there is that top right-hand box, $195,000 to get into your first deal. We'll run through this as well. So your ongoing costs. So these are your costs that you're going to cop every single year. Paying your P&I loan, you've got $875 a week. On that, that's a $600,000 loan on a 750K unit. Council rates at $3 grand a year. Strata at $3 grand a year if you've got the unit. Insurance would be covered under the strata. You got your water, your maintenance ongoingly. Total outgoings per week at $1,044. Now, for the most part, you can rent those things for around about $500 to $600 a week. You'll see as we go through this and as it scales up, the more expensive you go, the bigger the servicing gap, and it really starts to build and grow from there as well. But on this thing, you'd still be saving $500 a week, which obviously increases your serviceability. And in this, $370,000 in this example, plus the $195,000 worth of entry costs, which would get you around about 1 to 2 deals in today's market. Now, it starts getting a bit interesting. This one's still decent as well. I should have put Mount Druitt in that one. This is where it starts. This one's okay, but it starts getting bigger and juicier as we go further through. As you can see, we're going for a $1.25 million property there. You got your deposits all in. You're in for around about $300,000. Now remember, if you're bunny hopping and you bought the other one, you had your $40,000 worth of stamp duties. You're going to have sales costs on the way out if you sell that to go into the next one. Because in a natural transition, most people outgrow their home. If you're a young family, you might have been a 2-bedroom unit. Now you need a 3-bedroom house, and you can afford a little bit more. All the rest of it. So you jump into this thing. You got all your holding costs there on the right as well. So as it starts going through, 300 grand to get into this thing, $1,700 a week. Now, as you start getting more expensive, what you find as the property prices go up, your yield starts to come down. So even though the rents are increasing, it's nowhere near in line with the value of the property. So it's not like if you go for $750 a week and then you go to, $750,000 and you go to 1.5 mil, the rents don't just automatically double. If anything, they dip off, and they dip off a lot. And the more expensive you go, the more that they dip off. You're saving around about $700 to $800 a week on a rental there, approximately $900 a week saving. So you're saving about $45,000 a year, increasing your servicing by around about $484,000, plus those $300,000 in entry costs, which again, in today's market, is around 2 to 3 deals. Now, the beautiful thing of this, and I was talking before about limitless lending and understanding serviceability and creative lending, When you understand, like intimately understand how to redistribute and repurpose debt, that 500 grand, we can multiply that more and more times. So it's not just a singular 484,000. When you know what you're doing and you know how to play the game, we can roll that and rinse that again and again. So that's where the power really comes in. You get rid of it, and it's not just a like for like. Like, yeah, we can still do the deal that we would have taken, the $1 million worth of debt. We now get the extra $500,000 on top of it, but then we get to multiply that again and again as well. So again, if we rewind to where I was at 27, when I finally moved out of my primary residence and started my rentvesting journey, this is where it went on steroids, because all of a sudden I learned how to multiply that amount again and again as well, and that's where it really, really exploded with what I do now. From there. And that was 8 years ago. So I'm 35 now, moved out of it at 27. And pretty much once I learned how to rinse and repeat it from there. The other massive thing, guys, is that snowball effect that starts to come through. So we talk about, I know Ren, you was talking last night about the different value you get to if you keep reinvesting your dividends, right? From your shares or your stocks, whatever it is. Sorry, guys, I'm not a stocks guy, right? At all. I got one stock we were talking about last night. I don't even know what it is. My accountant told me to buy it, so I bought it. Anyway, one stock. I'm not kidding. He was talking about that, right? And it's so powerful, it's so important when you really understand this component and you commit to that side of things and you commit to reinvesting and keep putting it in. We see people talk about it all the time. They're going to buy a property and they're going to sit and wait and see what happens for 2-3 years. If it's your strategy, and you understand it, and you get knowledgeable around this, don't ever invest without knowledge. That is the quickest way to get burned. Only invest when you really understand it, or work with someone who can show you how to do it. Never work with someone who hasn't done what you want to do. The simplest way to find someone that you want to work with, whether it's in stocks, whether it's in shares, whether it's a business coach, whatever it is, the biggest lesson out of anything I could give you guys tonight, never ever work with anyone who hasn't done what you want to do. Because how are they going to show you how to do it? If you want to earn $200,000 a year or $500 grand a year or $1 million a year from property, don't work with someone who's never done it before, because how are they going to show you the path if they've never even walked it either? So you always need someone that's done what you want to do so they can actually guide you and take you down that path. I digress. This is where it starts getting really interesting. And this is where my journey went to a different level. When I moved out of my place in Mossy at the time, down the Southern Islands, it was probably worth around $750. This is pre-COVID boom. And when I moved out of it, I was able to get that rent up. I think I was renting it for $650 a week, and I think I moved down to the Gong. I was renting for $600 a week or something like that. And I increased my serviceability by around about 500 grand. Again, multiplied it. But as my portfolio started to really grow and compound, I started having a lot of passive income that was coming from the portfolio. And I realized that I could, if I wanted to, go and buy something bigger, go buy something better like this. But I started getting to a level where I could go buy something like this. And then I started running these numbers, and this is where the penny really dropped. Because what I realized was when you start getting to this sort of value, again, like I said before, the rents, they just don't grow in line. And so you start getting to this sort of value, and your yield starts sitting around about 2%. Now, I don't know who would buy a property with a 2% yield. I know everyone loves to talk about blue chip. Well, there's a lot of people who like to talk about blue chip. Don't start getting me started about blue chip. We got pretty fired up last night down in Melbourne. But this is the sort of asset that if someone is silly enough to own this as an investment, this is the sort of property that you want to live in and rent in and pretty much milk off them for the silly decision that it is to own something like this as a rental. Now, when you start going through this, 630 grand to go get into this asset, you got a $500,000 loan, you got $130,000 in stamps, you got obviously building a pest, but then this is where it gets really expensive. 170 grand a year in mortgage, in total running costs. So your mortgage is sitting at around about 150 grand there, plus the extra cost. You're sitting at about 170 grand. Now, I don't know how many people in the room, I know Sydney would be the highest income in Australia, but I don't know how many people in the room would have disposable income they could service a mortgage and the running costs of a house of 170 grand a year. You're probably needing to net household probably circa 400 to be netting that and still be able to live. That's a lot of cash, right? That's a lot of cash to be outlying. You're taking on a $2 million worth of debt, $2.5 million purchase, $1,200 to $1,500 a week rent. And I can say that because I jumped into something like this myself when I first moved up to the Gold Coast. you're saving around about $2,000 a week and increasing your servicing by $912,000 plus the $630,000 in entry costs. So we're talking 4 to 5. Like if you're putting $150,000 into a deal as an investment, we're talking 4 deals plus change left over on that, plus your $912,000. And remember, when we understand how to really redistribute, repurpose that debt, keep multiplying that debt, that starts to become really, really powerful, and the gap starts to become massive. Most people, when they start going through their journeys as well, let's say people in here are in their 20s, they buy their first home, and it's that 750K one. And then we're in their early 30s, they buy the 1.25. You save away, you pay down a bit of debt, you go through some promotions, you go from $200,000 household income to $300,000, and you go, you know what? I want to keep up with the Joneses. I want to keep up with all the mates and everything. How many people in the room, everyone that they know, actually, you guys probably don't want your hand up, but know people that are under serious mortgage stress right now that are friends of yours? Come on, there's more than you in Sydney with that. I know there is. Seriously, right? Serious mortgage stress. Because they want to keep up with everyone else and buy this shit. Look at the difference. We're talking $2,000 a week saving. We took $100,000 a year saving to rent it versus owning it. Can you imagine what you could build in your portfolio doing that instead? If this was me, as an absolute minimum, rent something like this for 5 years and just buy 2 properties. Buy 2 very well-placed properties for $500,000, $600,000, $700,000, something like that. Run it through a growth cycle over 5 years. See, 60 to 70% capital growth is a minimum on assets like that if you select the area correctly. You're going to net out around about $300,000 per property. So if you did 3 of those, you're going to net out pretty close to $1 million net cash profit. You could roll into this and drop your loan, drop your LVR by $1 million. $1 million, 6.5%, just interest only is $65,000 a year. With P&I, we're talking about $80,000 a year. You'd be able to wipe off just by doing that one strategy instead of going and doing that. But if you multiply it, you see, if you could multiply it and grow it to say 6 or 7 properties or something like that at that lower price point that goes through that cycle, ride them through that growth cycle, sell them down. You almost be able to buy this thing in cash in a 5 to 7 year window. People probably think I'm crazy with that. I guarantee you I'm not crazy, and I've seen plenty of clients actually go through and do this exact strategy by embracing this. And a lot of them have actually sold their primary residence to go down this path because they knew they couldn't afford to do the next jump. They needed to, they wanted to, but they actually were able to sell out of a home at say $1.5 million and go and rent this asset and actually cost them less than it did to own the $1.5 million. Now the next property at this sort of level, this is where we're going, the nice house. Most people in this room probably dream home. Some of you might want to go a little bit deeper in this. Some might want to go a little bit less. But for most people, I know when I was growing up in Sydney, my dream home was probably around about $4 to $5 million. It was a nice big farm down in the Highlands, Burradoo, big house, beautiful. It was around about $5 million, $4 to $5 million back then. The crazy, crazy thing is that they are bugger all to rent. Because the dearer you go, the smaller the pool gets. And it's not that you would go and rent this thing straight away. Maybe you would if you had the money to do it. But as you build the portfolio and you start to scale, like we look at these costs here. If you buy this at an 80% LVR, so 80% loan to value ratio, you're putting 20% deposit in. That's $1 million on a $5 million asset. It means you're borrowing $4 million. So your total cost on the way in are almost 1.3 mil. Your loan is $300,000 a year. All holding costs getting thrown at $350,000 a year. I don't know how many people in this room you're needing to make about $600,000. So you can net about $450,000, and you can pay this thing at about $350,000, have $100,000 a year in living expenses. I don't know how many people in this room making $600,000 a year combined in the household, but that is a massive amount to carry. But at the rental yield or a rental, on something like this being around about $1,800 to $2,500 a week, you're saving almost $4,500 a week. A week, $4,500. We're talking over $200,000, $220,000, $230,000 a year you would save in renting this house versus owning it, and increasing your servicing by around about $2.5 million. So not only the $4 million that you wouldn't be putting into this, but another $2.5 million that you would have on top as well. That's the difference between, and when you go to these sorts of levels, that is the difference in servicing and the difference from an investment perspective to go down that route versus owning that home. And there's nothing wrong with having the dream to own this home in time. But you look at like what you could do here. You're talking 1.3 million entry costs, circa 10 deals. you've got 4.5 mil, servicing you can have with this, or at least 2.5 mil left over. The portfolio that you could grow and scale by not buying something like this early. And there might be some people in the room, they got a $2.5-3 million primary residence, and they're wanting to keep up with the people they know and try and jump into something like that. But it's going to push them to the limit, right? Push them to a point where they undoubtedly probably aren't going to be able to afford this thing. But this is that dream style asset. And this is where, I'd love to know how many people in the room would love to own something that's like, what's their dream home being around about 5 mil? More or less, 5 mil? A fair few. More than 5 mil? There's a few. All right, sweet. But this is the sort of thing, like 5 mil, it's funny, in Sydney, it doesn't get you that much anymore. I was having a look around, it doesn't get you that much. This is the thing, renting something like that isn't that expensive. But what I would do in a scenario like this, for any of you that do want to own something that's like a $5 million primary residence, and whether it's 2, 3, 5, 10, whatever it is, what you can do when you look at something like this, right? $2,000 a week is generating a passive income of, say, $100,000 a year first. You could generate $100,000 a year worth of passive income, build that out first. That would literally service the loan on this thing while you then went and built a portfolio that you could produce and generate and actually build towards generating enough income and enough equity to be able to buy this thing at maybe, instead of being an 80% LVR, maybe it's a 20% LVR, 30, 40% LVR. Dropping that loan down to 1, 2, 2.5 million. But remember, building the portfolio at the same time that potentially can service the debt at the same time as well. Most of us, and if you guys are in here and you're investing, everyone with investing typically has big goals, right? We don't start off with small goals. Whether it's replacing an income, whether it's owning a $5 million home, whether it's buying a Ferrari, Lamborghini, yacht, whatever it is. We don't do it for fun. Some of us do, right? Tiny percent. We do it to achieve financial freedom, passive income, choices, all the rest of it. And typically, and what I guarantee you is the further that you grow through this cycle, the more that your psyche will change in terms of what you guys actually want as a primary residence, because you'll realize what's possible. But you have to start with stuff like this and start building and growing and moving through the process around these different things. And when you do, when you embrace this side, specifically around debt in property, and when you understand the game around that, this is where stuff like this can become very, very real. But it's employing all the different strategies that you possibly can. It's a creative lending. It's the rentvesting. It's embracing the debt, understanding cash flows, all these different things. When you compound and leverage to the best point that you can from this perspective, this is where stuff like this is very, very real and very possible. But it's challenging the status quo. It's not going down the norm, buy and hold forever. Or go and buy the primary residence first, then build the portfolio. You're doing these things in the wrong order. You have to treat your portfolio like a business, treat every property like a business. And I'd actually love to know, like, how many people in the room are just holding properties like who? It's kind of off topic, but we're kind of going there. Who believes like a buy and hold forever strategy in property? They're too scared to put their hand up, I reckon. Buy and hold forever? What about the 10 years the market does nothing? So the property market, guys, it moves in cycles, right? And it very, very much does move in cycles. And typically markets will double in 3 to 4 years, and then they'll flatline for 10. People talk about Sydney as if it's a beast, as if it never stops growing. In 2003 to 2013, the market did nothing. Brisbane, Perth, Adelaide, Darwin, Hobart, sorry, I'm trying to get the extra finger out there. They all doubled. They did 100 to 150% growth in that time frame, and Sydney did nothing. If you doubled your money in those markets, brought it back to Sydney in 2012, you would have doubled your money or more in Sydney in 2013 to 2017. Treating your portfolio like a business, if you then sold out of Sydney in 2017, 2018, and then gone into Brisbane, Perth, Adelaide, Tassie, any of those markets, you would have doubled your money or more. Some of the properties in Brisbane, Adelaide, tripled in that time frame as well. And yes, you saw a little bit of growth during COVID as well. But moving your money around and treating your portfolio like a business is how you make money in property in the long term. And holding properties forever is how you get stuck. Because ultimately, it doesn't matter if you make $1 million a year or if you make $20 million a year, there will become a time where you run out of serviceability. So you have to treat your portfolio like a business. You've got to understand the cycles, and the biggest thing is income to house price ratios. It's the income to house price ratios. And that's why Sydney is one of the best cities, probably the best city in Australia to rentvest, because the income to house price ratios in Sydney are absolutely cooked. You guys are sitting at like 15 to 1. It's crazy. the potential for exponential growth is no longer there because of how much growth you've had and how expensive it is compared to incomes in the areas. So it's cooked. So it's finding those imbalances and finding where the ceiling of those markets are and then where you should be moving after that.
Nice. Love it, Sam. Give it up for Sam. I think tonight is obviously about property and stocks, but Sam, you're obviously 100% property.
No, he owns
I got one stock. Wait, I remembered what the stock was. I looked it up.
What was it?
It's Chilwa.
What?
It's a mine in W. I got a hot tip from an agent over there.
Okay.
When I bought it was 20 cents. It's $1.
Really?
A year ago, yeah, 100%.
Okay. Do you have any stocks in your superannuation?
Yeah, I put a little bit of that in there.
Nice.
Well, I was about to say...
I've got to diversify, right?
I was about to say we should take the lesson not to take a stock tip from a mate or an accountant, but if you're making money, then I guess you're really disproving that. I think the one thing that hopefully Sam's prezzo is dispelling is this idea that rent is dead money. This idea that I think we often hear from parents a lot of the time that, you got to get into a primary place of residence as quickly as possible because otherwise you're just paying off someone else's mortgage. Well, if you're renting, but the difference you're using, be it in property, be it in stocks, whatever, you can still build wealth as a renter.
Yeah, I'll just say here before we move on that we will have a Q&A session at the end. If you scan this on your phone, then you can ask questions through your phone. You can all upvote the questions. We'll get it on our phones and we'll be able to answer them as we go.
And if you want to continue an argument with Sam after that, he'll be sticking around after, corner him somewhere, and he'll...
I'm happy to have it live.
But look, we want to play a game. So we've got someone who predominantly focuses on stocks and someone who predominantly focuses on property here. And I guess what we want to do is unpack a variety of portfolios and properties to try and understand how they approach these assets, what we can all learn and apply to our own investing journeys in a game of deal or no deal. We should have called it in a game of buy or sell. If anyone's listened to the podcast this week, the wonderful Ali Selby, who's taken a seat right at the front, is hosting buy or sell. So make sure you give that a listen. But can we give her a round of applause, please?
Yay.
Woo. Now, Ali, we won't get you to come up and host this time, but make sure everyone goes and listens to that podcast because it is a cracker. All right, so we're going to go stocks, property. We're going to alternate. Sam, as the guest, we're going to start with you. We have got this lovely house in Burke.
Yes,
take a look at the listing. You can see the price that was paid. Now, deal or no deal, and then we want you to unpack your thinking. But for starters, Sam?
Deal.
Anyone in the room own a property in Burke? Well, I thought you were about to put your hand up there, man.
This one?
Yeah. No, yeah, he's bought this one. It's under contract at the moment. No deal.
Okay, now for people who aren't as plugged into property as Sam, I think Sam will probably know the answer to this. The reason we've included Burke is because it is one of the fastest growing regions, I guess, towns in Australia. So Sam, even though it's growing quickly and you had your whole conversation about trying to find places that are doubling and tripling, why is Burke not a deal?
Man, I think, all right, so it's had one of the fastest growths in the area, right? Oh, sorry, in the country. And it's 265 grand, a fully renovated 4x2. I think that tells enough about the area and the values of where the area is. And probably the volatility, like it's a tiny, tiny market as well. Very, very small town. Extremely hard to get funding on things like this. So something like this, you might struggle to actually even be able to get a loan on or have to do it at 50% LVR, which lowers your return on investment because you're putting so much capital into a singular deal. But man, like, right, you got a 4-bed, 2-bath, fully renovated home on a 1,300 plus square meter block. And it's 265 grand. Like,
I mean, you say that.
Be like?
I'm going to try and convince Bryce to move the Equity Mates headquarters out.
Yeah, seems like a bargain.
All right, so it's no deal, Bryce. Over to you. Now, these are portfolios from our Melbourne live show. So let's see what
we got
thinks about this. Deal or no deal?
Nice. Okay. I guess if we go back to our principles of good quality portfolios that are set up for the long-term low cost, it looks like there's some makings of that here. We've got the index ETFs, IVV, VAS making up about 30%. We've got G-Just in there, which is a bit of leverage, which I love, a bit of a tilt towards uranium and Bitcoin. The one thing that will stand out for me that gets me a little worried is GQG. It hasn't been performing too well over the last 12 months. I think you find these fund managers, it's all about inflows and outflows, and I think GQG has been suffering a bit of outflows of late, and the share price has followed. So I think structurally it's really good, but some stuff in there that I'm not too keen on.
Yeah, I think someone's been stitched up in the categorization here because that Euro Stocks ETF and the Geared ETF are both index ETFs as well. It's 60% in core index ETFs. So we do like to see that. All right, was it a deal or a no deal?
It was a no deal.
Okay, all right, let's see if we can get one on the board. Over to you, Sammy. We're going to the NT. We've got a price guide of the high 500,000, so you can use your imagination there. Deal or no deal?
So NT's, surprisingly, to some, the strongest performing growth market in Australia this year for a capital city. You got a 3-bed, 1-bath, double garage, 885 square metres. You got a high set home, keeps the crocs from getting in.
Big pool?
Yeah, the crocs go in the pool.
Yeah.
Nice.
Yeah, I mean, you're talking high 500,000. You're in Driver, which is in Palmerston, about half an hour out of Darwin itself. You're at a very high price point. A lot of people don't realise the amount of growth that Darwin's actually already had.
What are we talking? Wow.
It's not a secret.
I'll tell you honestly.
Yeah.
Yeah, well, don't lie.
Don't lie. Yeah.
Yeah, that's true. That's true. We would have bought something like this 12 months ago for about 380, 400,000. This would sell for 600 grand. So in a 12-month window, we talk about timing markets versus holding them for the long term.
You've really stitched yourself up by
No, that's right. That's right.
pointing you every time now.
That's 60% growth in 12 months.
Yeah. Okay.
And that is possible.
So wait, but a deal or no deal?
No deal.
Okay. 12
Would
months
have been
ago,
a deal.
It would have been a deal.
Yeah, that's what
So I think
not that money.
For like we want to.
What you got to remember as well. Sorry to cut in on you 1 sec. You got a fibro home there, high set fibro home. So this would be a 60s build fibro. I don't know what the inside looks like as well. But you're talking 600,000 out in Palmerston as well for that. You've already seen a massive amount of growth. Yeah, no deal.
So I think we want to really draw out like how you approach this as well. And so we've given you just a listing. Obviously, we haven't shown you any photos of the inside. So maybe we're stitching you up. But like when you're, scrolling Domain or realestate.com, what are the things that you're looking out for that we can also look out for?
For sure. So first things first, and the reason why I said no deal almost immediately and why I went into the area is because like before you're even having a look at a property, you want to understand the area, where it's at in the cycle, how it's been performing, where you think it's going to be sending or going to as well, and then how much growth you think it potentially has left in the tank. So that's first things first. Let's say that this did meet the criteria of that. The things I'd be looking at on this place, again, let's say it did meet the criteria of actually falling into the price point that we thought it was going to fall into. You'd want to know the overall condition of the actual home because you have got fibro the whole way around the top level. Your supposed see, they've got a bedroom 4/rumpus there, but only listing as a 3-bed. That's not a legal bedroom downstairs either. So yeah, you're pretty much looking at that and trying to understand that. And a lot of people would see the floor plan and go, oh, it's actually got a 4th bedroom, but it wouldn't be a legal 4th bed. So you have to really understand that and value it accordingly against that home. You'd really be wanting to make sure the condition around that it's in very good condition because fibro is actually fine. I would have 10, 15 fibro homes in my portfolio, but they have to be in good nick because if they're not in good nick, they're very, very expensive and a dangerous asset to own. So as long as it was all in good nick, it'd be sweet. But if it wasn't, you've got a high set that you need to get scaffolding on to do the work as well. So it's like there can be a lot involved in that if it's not in good condition. So you have to understand that before you buy it. If it's damaged, once you own it, you could probably cover it under insurance. But if it wasn't and it was missed, that could be a very, very expensive thing to need to fix.
Nice one. All right. Well, Bryce, back to you.
All right.
We've got a all ETF portfolio from Jeremy down in Melbourne. Deal or no deal?
I don't mind it. I think gear here there's also a typo. Beta shares, I think that's meant to be the Australian geared, not the US. But again, we've got almost 90% here in all US. Really. I think if we look at long-term diversification, there's not too much diversification going on here. In fact, I would probably say that the top 10 or 15 holdings for IVV, NDQ, not gear, FANG and SEMI are very, very, very similar. So I'd say way too much overlap going on in this portfolio and huge weighting towards US. So no deal.
Yeah, I I know you're playing the expert in this, but I hate that weighting there.
Yeah.
2 massive holdings and then 4 1%. All right, Sammy, where are we going next? Actually,
Well, hey.
so before...
I'll give this one a run.
That's my place.
You grew up there, eh?
So for people who are unfamiliar why we're reacting like this, Bryce is from Wagga and he holds a soft spot in his heart. So before we get Sam's opinion, Bryce, deal or no deal? But I also want to know, do you have any memories from Docker Street that you can share with us tonight?
Docker. I can't even remember where it is.
Okay, all right.
I think it's in town. It's in the centre of town. We've got a classic 3x2x2 on a 607 metre, $669,000. Full brick, double brick. We've got a tree out the front.
How many beds?
2.
You said 3.
Damn it. 2x2.
All right. Deal or no deal?
I'd say deal.
All right, Sam, deal or no deal?
No deal.
All right.
Hey, 670 grand for a 2-better.
I'm anchored to Sydney prices. This is looking pretty good.
So what are you looking at here, Sam?
So I wouldn't call exactly no deal on this thing.
Okay.
I would. Well, no, I was mucking around. But in all honesty, I don't know the exact values of Wagga itself within it. But what I would be looking at from a floor plan perspective, let's say this thing was valued at the time. So this is where you can look for a bit of value, right? If you look at this asset, if they've genuinely priced it as a 2x2, and that's what market value is in that area, let's say market value 650 or whatever for a 2x2, and you can buy for that. That front lounge room being 5.2 by 3.8, you'd make it a semi-pokey bed, but you could split that. See where the entry comes in, it goes all the way down through the dining kitchen. I would open up that walkway there through the dining kitchen, that wall, just as you walk straight through, I'd open that whole wall up and then close that lounge room off. You could either turn it into a 3-bedder and then you have a 3x2. If it was feasible and if the measurements actually worked out, you could split that down the guts, that lounge room, and potentially try and turn it into a 4x2. It would potentially be a bit pokey on the double bedroom at the front, but there could be 2 kids' bedrooms at the front, and then you got a 3, but you got 3 and a 3.5 bedroom there. It's not en-suited, and you got the bed. I mean, the baths are a little disjointed. I mean, you could turn it into a 4x2 there with 2 kids' bedrooms in that front lounge. You could potentially add some serious value on for that thing. I don't understand the values well enough to know how much value you would add on, but potentially, maybe.
What I'm hearing is you came out strongly against Bryce and then you came with his opinion.
Yeah, well, I had to take him on and recover.
I know the area.
All right. We've got another portfolio. Sam, I won't ask you to play the stock expert here. We'll stick with Bryce. What are you seeing? More than 50% of the holdings.
Yes.
2 Aussie large
caps. I am seeing someone who I hope to God works for National Australia Bank or Wesfarmers. 30% of the portfolio in Wesfarmers, 26% in National Australia Bank. Way overweight Australia there. WiseTech hasn't had a great year, we know, with Richard White. Not too bad with Alphabet and Nvidia, but I think the weightings are all over the shop here. It feels like, I don't know, no offense to Tom S. from Melbourne, but a bit of a spray and pray approach. I'm not really sure what the strategy is, to be honest. No deal.
Nice. Okay, where are we going on this tour around the world? Take us to Western Australia, Sam. What do you reckon about this one?
This is Stitch Up. This is one of mine.
We don't have a price, but I have a feeling you might be able to give us an indication.
Yeah. So I just sold this.
We got some inside word.
Thanks, Kel. So actually a little bit of a story on this one. So I bought this one off market. What would it have been? Start of 24. Yeah, start of last year. This was a crack house.
Value,
great value. I paid $250. Now, something like this is something I wouldn't give to a client because we knew that there'd been meth use in the house, and it's hard when you buy something like this. In WA, they're all double bricks, right? So I have to worry about. Crack houses typically everyone would freak out, right?
Who thought they'd be learning about? Crack
this is taking a weird turn.
If you use, I'm going to give you a methamphetamine.
We've done 8 years of equity, mates, and I can honestly say we've never had this conversation before. So teach us, Sam. What do we need to know?
I'll teach you how to make some money. All right. You've seen Breaking Bad, right? All right. So in all honesty, this was a very close agent relationship of mine in Western Australia. This is in Coodnup, Mandurah region, 4-bed, 2-bath, an hour south of Perth, 5 minutes to the beach. I paid 250 grand for this thing. It's a 4-bed, 2-bath. It was actually massive. That massive carport leads into a huge patio at the back. It had all the right bones, but we knew that it had meth use, right? Now that's not for 99% of investors. It's an immediate red flag. And in all honesty, if you don't know what you're doing, it should be a red flag and don't get anywhere near it. In WA, it's slightly different because everything's built as double brick. Your biggest cost typically, if you get something that's literally been like a cookhouse, as funny as that sounds, if it's been a cookhouse, all your interior walls will all be, it will literally seeps into all the walls and you can't get it out, right? There's nothing you can do. So you have to literally strip the entire house, if it's even possible, and then completely redo them. Typically costs somewhere between $60,000 to $100,000. Now, depending on the size of the house, something like this, I was anticipating it could be somewhere between 60 to 100 grand. The beautiful part is that's exactly what I talked up to the agent. Even though you can see all those internal walls there with the black, they're all that's all brick. So that's all brickwork, right? So the only thing that I had exposure to was the actual ceiling. So it's all brick. It's all double brick internal. You got roof trusses, and then so literally my only exposure was the ceiling. Paid 250 grand. If this thing was in good condition at the time, market value would have been about 400 grand. Paid 250, and the expectation I was probably going to be spending circa 60 grand, I thought, renovating it. Had the meth test done. It was only the master bedroom that they'd been having some sessions in. So it was only the master bed. I think it cost me... they literally go in there with like a gurney in this chemical and they clean it. And I'm pretty sure I stripped the roof in that, redid that. The whole renovation cost me 23, 24, I think it was, something like that. 23, 24 grand. Round up 275, call it all in. The renovation at the end, it was also, the guy had a psychotic meth crazed run thing, and he went through the house with an axe and he ripped all the doors off as well with an axe. They literally had massive axe holes and shit in it. It was hectic. I went through it and I was like, this guy's gone crazy. So I replaced all the kitchen cabinetry, all the doors in the whole place, the ceiling in that master bedroom, sprayed it. Literally everything else was pretty sweet. I think it was 23, 24 grand, 275 all in. It would have been worth at the end 400-ish. I bought that at the start of last year. I sold it. We literally just sold it. Yeah, I held it for maybe 18 months. What did I sell it for? 590, 595. Something like that. So I paid 275, sold it for 595. So over 100%, about 120% growth in 18 months.
Deal.
Full credit.
Deal. But in all seriousness with something like this, it's agent connection. So knew it, had it off market. Also knew the risk. This thing could have gone the other way, and I've had other deals that have gone the other way. I've bought plenty of deals on this sort of level that I wouldn't give to a client because it could blow out to $100,000. And that's the risk that I'm willing to take on because I've built the portfolio big enough. I've got cash reserves, and I've also got the risk profile that if I do 10 deals like this and 2 of them, blow out and I break even, I know I'll make money on the others, and it's okay. It's all part of the journey, part of the process. The average person shouldn't take something like this on because it is a big deal.
All right, well, we got to keep moving, but if you have any crack house questions for Sam, put them in the Q&A at the end, upvote them, and we will answer them. Sam, we're actually going to stick with you. We're going to bring you back to New South Wales. People here probably live in Potts Point. You can, if you're lucky, you can buy a 1-bedroom apartment for $1 million in Sydney these days.
I won't buy this.
Deal or no deal? All right, talk us through it, because I think a lot of people in this room are looking at places in Sydney, probably more primary place of residence rather than investing, but people are probably seeing a lot of floor plans like that and a lot of price guides like that.
What would this cost to rent?
$1,200 maybe? No. 9?
Does anyone know?
9?
Yell it out if you know.
$900.
I have no idea.
8, 9, yeah.
$800 a week.
So this is kind of that. And would it actually sell for that? Do we know, or like are they underpricing?
That'd be undercooked for sure.
Yeah.
So it kind of falls into the bracket we were talking about before of that kind of, potentially 1.1 renting for $800-900 a week, whatever. This is just like the sort of thing that you would rent. Now, remember, this isn't the style of asset that you would. This isn't. I doubt very much is it anyone's dream home, right? So in all reality, sorry if it is anyone's dream home.
Unit 103. So it's also a big, big.
But it's the sort of thing you'd rent while you're investing. You know what I mean? It's not it's not anyone's dream home they're probably going to be aspiring to. So again, it's not something you would go and take on $800 million worth of debt to then slow your journey down when it's not even something you ultimately want to retire in.
All right. Well, no offense to anyone who lives in Potts Point. Let's keep moving, Bryce. We're going to go back to you. You probably don't have as good a story as Sam just told us about crack houses, but what are you seeing here?
What are we seeing? Okay, we're seeing some active management for the first time for a while, which is interesting. So firstly, I don't mind NDQ, great ETF. Qual is very popular as well. First time we've seen Asia ex Japan as well, VAE, which gives great exposure to Asia. So I think from that point of view, there's a decent sort of global mix going on there.
I mean, tiny weighting though.
Tiny weighting, yeah. The two call-outs here, we had a look at this before we came on with active managers, is A, you want to be looking at your fees comparable to what you could be getting on the index, and B, you also want to be looking at the performance. I think with the Dimensional Australia Core, their benchmark is the ASX 300. I think from memory it was 0.28%. If you were to compare that to, say, the A200, which obviously isn't apples for apples, or VAS, for example, it's been sort of borderline performance, but you are paying more for it.
So to be clear, what you're saying is you're paying 0.28% of your money in fees to the active manager rather than what, 0.04% these days?
Yeah.
And it hasn't outperformed.
Yeah, you'd want to be getting outperformance if you're paying for, more for what you could get otherwise.
So that's the Aussie one. What about the global?
Yeah, sort of a worse story, I think, from memory as well. The global core has very similar top holdings to what you would see in your S&P 500 or the like, and it is significantly underperforming. So I would be looking at those two to replace with just your classic core, and then they've got some individual stocks here. So yeah, a bit of a watch on the active management.
Yeah, a quick explainer for people who are new. We have been called the Index Boys before, named after the Island Boys, if anyone remembers them from COVID. Active, the reason we love index funds, these, ASX 200, S&P 500, these vanilla, just buy a bit of everything ETFs, is because it's really hard to beat them. There's a lot of highly paid active managers that will hire a lot of smart people and get all the latest technology to try and beat them, and they often struggle. In fact, S&P Global track how much they struggle, and over the past 15 years, 85% of Australian active managers haven't beaten the most vanilla ASX 200 fund you can buy. So that is why we are the Index Boys, and that is why we have a very high bar for active managers getting into our portfolios. All right, Sam, I think we've got one more property from memory.
I think so, yeah.
We're going to keep you in New South Wales. What do you reckon about $1.7 million for a two-beddy in Paddington?
Blue chip, baby.
Yeah, there's always going to be demand for this,
Oh, you always got me riled last night. No, definitely not. Definitely not. So something like this is what we kind of ran into last night. Something like this, in all reality, would cost you in the vicinity of 50 grand a year to hold. We used that example before of Sydney when we were talking about it. If you bought into a flat market, literally, and or if you bought in at the top end of a cycle, we don't know how much further, if anything, somewhere like Sydney's going to run, right? Something's costing you 50 grand a year to hold. Like you're not just carrying it because I'm expecting over long term because it's blue chip, it's going to give me this performance over X amount of time. 50 grand a year that you have to make back. Now, if it's flatlining and does nothing for the next 5 years and then starts a run in 5 years, that's 250 grand in growth you have to make in year 5 to break even. You know what I mean? It doesn't make sense to me to buy assets like this that cost you such an exorbitant amount in negative cash flow every single year if it's not going to perform, if it's not going to give you a massive return immediately.
All right, one final question about New South Wales. In your whole property portfolio, or Sydney specifically, do you own anything in Sydney?
Yeah.
Okay, so there are investments in Sydney, just not in Paddington or Potts Point.
Yeah, I bought them in 2012 and 2015 are the only ones I got left, and they've quadrupled in value. So they're up massively. So the ones I still own down in the Highlands, but I'm actually selling off at the moment. think I paid 355 for one, and I'm about to sell it for 1.2 and 550 odd for the other. It'll be again 1.2 mil. But man, like it's.
I need to stop hearing about how much money. This is
but the thing is that in my opinion, man, they're done. You know what I mean? They're done. And I look at velocity of money. It's like this, like velocity of money. What could you do? 1.7 million. Go put it somewhere else that's in a market that's going to see, you know, a nice cycle right now. We go back to the example before of NT as well, and like what it's done in the last 12 months. But even something that gave you a 10% run on a $600,000 asset that was costing you 10 grand a year to own, you're netting 50 grand a year in front. If it's $10,000 a year negative to hold that asset, but it grew by 10% on a $600,000 asset, you're 50 grand a year in front. If this thing does nothing, costs you 50 grand a year, you're 50 grand a year behind. Why would you own that?
all right.
In Paddington, dude.
Why would you own that?
Hold on.
You know what I mean?
So we've learned from Melbourne. We followed up when he started asking these rhetorical questions, and we spoke about Paddington for far too long.
And then I took the mics off and I had a rant for 10 minutes.
I'm going to keep moving because we want to give you guys time to ask any questions you have. Bryce, I've got one last one for you. We got Sam looking at something he may be familiar with before. You may
I'm
be
in love.
familiar.
I'm in love, finally.
You may be familiar with this one. Deal or no deal, and tell us.
So what we're seeing here is a really nice mix of a core portfolio. We've got Gear and GJUS, which is a leveraged exposure to Aussie and US equities. Then we have an even weighting between, well, I don't know if it's even, but we have a weighting between Asia and Europe. So full global coverage with a tilt towards leverage. Thematic then coming in, which I like, 8%. Semi's done well. ATEC, I think, is an awesome Australian ETF. Gives you sort of some exposure to the Aussie tech companies. Small caps as well. This is a managed fund. And then a nice handful of holdings for individual companies.
Now,
all really good stock picks, I must say as well.
He said he didn't know if they were evenly weighted. Full disclosure, he does know if they're evenly weighted because this is Bryce's portfolio. So if you want to take a photo of it and then track its performance over time, you can bring that up with him.
I was going to say no deal, but I'll take that back.
If you got any problems with it, bring it up with him later. Let's get to the Q&A so you guys have a chance to ask any questions you have. We know it's a school night, so we won't stick around too long. The way Slido works is you can upvote other people's questions as well. So if you like a question and you want us to answer it, upvote it. I don't think you can downvote if you hate someone else's question, but...
That'd be cool.
Yeah, well, I'm just going to keep padding while people ask questions. And then Bryce, when he's ready, is going to ask us the first question.
Hang on. All right, first one. All good saying don't buy and hold. Then we're all moving around. Hang on a second. All good saying don't buy, don't hold. But how do you know where to buy, Sam? Seems like everything presented didn't make the cut.
Yeah, it's a great question. It's a great question. You've got to, it was kind of as we were talking about before, like understanding cycles, incomes to house price ratios as well, like understanding all of that, where different markets are in their cycles. One of the biggest things we were sort of talking about earlier was really understanding that income to house price ratio is one of the biggest predicators of whether a market has potential to go through substantial growth or not. And I think it depends on what sort of investor you want to be. Do you want to be an active investor or do you want to be a passive investor? And the idea of buying, holding for the long term to me is a very passive way of investing. Whereas if a market's finished its cycle and you can either, if you've got the ability to refinance equity out of it and keep moving around to other markets, it makes sense. But if it doesn't, and if you don't have that ability, then clip the deal and keep moving forward. But there's so many different indicators around selecting that, but things like infrastructure projects, population growth, different drivers in markets around those style of things will push a location, but it will depend on supply as well. It's a massive piece of it.
I'm just going to jump in and give another shameless plug. We ask Sam this question a lot because we do try and understand his process. So if you look up on Equity Mates, any of the interviews we've done with Sam, you'll probably hear us asking him that question and trying to get his secret sauce.
Every episode.
Just as well, the question we get a lot is around your approach to thinking about capital gains, and I think obviously applies to both. But like, if you're just constantly selling, like, what is your approach to that?
I love it.
You love the tax, man.
Man, you're paying tax, you're making money. I heard a fella say it before around paying capital gains tax. Why are you scared of tax? In property, right? You have 50% capital gains tax exemption. So if you make $1 million out of selling 3 deals or 2 deals or whatever, you have $500,000 that's exempt, and then $500,000 it'll be even if it's at the highest tax bracket and you pay 45 cents in the dollar, you're going to pay $240,000 in tax, but you'll clear 760 grand. It's a natural cost of doing business, and by holding that asset, not doing anything with it, when are you ever going to actually realize your gain? in property, and especially in residential property, the yields are not strong enough to hold for the very long term. Like if you run the numbers on something like a property that, let's say, is worth $1 million and then it grows to $2 million and you hold it and you don't do anything with it, what's the point of actually holding that asset? Because the yield will never grow in line with it. It will never be powerful enough. But if you were able to sell that out and go and buy a commercial asset at $2 million, it would have double the net rental yield. But you may not be able to do it because you hold on to that singular asset, say in residential. If you were to clip that, roll it into it, I challenge you to run the numbers on an asset like that instead. The net cash flows, which is what you can actually retire on. You retire on the passive income. You can't retire on equity that you don't tap or profit that you don't bank. It's a cost of doing business. I love capital gains tax. It means I banked serious profit. That deal I showed before, the crackdown, right? It was $275,000 all in. I sold at $595. $320,000 profit, clear profit, like profit on that. I have 160 grand. It's tax free. 160 grand that's taxed at the highest tax bracket. And she's going, what's that, 70? I'm still clearing 250,000 net on an asset like that. I don't care. It is what it is.
Now, there's a lot of questions about property. It wouldn't be an Australian investing event if it wasn't property dominated. But there's one question that I just want to quickly ask Bryce. Have you given up smoking yet?
No comment.
See him outside after. I guess, Sam, we'll stick with you given we've got an overwhelming number of questions about property. Also about cooking meth. So we might save that for after.
No, get the meth ones now.
If you were to buy a property in Sydney, Sam, what suburb would it be in?
Do yourself a favour, don't buy in Sydney.
Okay, we probably
wouldn't buy in Sydney. Yeah. What's the point? Like the whole point of investing in Australia is to make money, right? Like if you're not going to make the money out of the asset now, I just wouldn't buy in Sydney. There's significantly better locations to buy and invest in right now than Sydney.
Fair enough. All right. What about, so a lot of people here who do have their primary place of residence would be trying to load up their offset and trying to beat that mortgage as quickly as possible. How do you approach the question of using that offset versus investing?
You can't save your way to retirement.
Fair enough.
You have to invest, man. Like it's.
What about Bryce? I'll turn to you. We'll get some stock chat in here. Loading up your offset versus investing in stocks.
I mean, there's a mathematical equation to it, which is looking at what the offset is doing from a returns point of view. So I think, my offset at the moment is effectively saving 5.9%, and that's after tax. If I then have to weigh up whether I'm putting money in the market, you want to be probably expecting a return, I don't know what the maths would be off the top of my head, but probably 8 or 9%. When you're taking into consideration tax. So that's the mathematical way to look at it. What's just going to be the best absolute return. But I think at the end of the day, for me, it's like, how can I try and achieve both?
Yeah. Do you mind if I throw one little thing on that?
Sure.
Because they made me so short, so blunt, guys, sorry. But like if you have 100 grand sitting in offset, I used that example before. You go buy a $500,000 asset. If you have the $100,000 sitting in offset in that example before of 5.5%, that's $5,500 for the 100 grand. But if you were able to go put that into an asset at say 500 grand and it grew by 10% in that year, you're making 50 grand versus saving 5. That's why I don't believe you can save your way to retirement, and the investing side is good, but that leverage return in property to me, if you can select the correct property markets, that's where you can make some serious coin from that leverage piece.
I'm going to clear some of these questions out for whoever's running the Slido. The question, Sam's top 5 areas in Australia to invest in. He never tells us.
Yeah.
Unbelievable. The question, where is the next hot market to buy in? He only tells us after the fact as well. But if you want to hear, the best place to go is Equity Mates Investing Podcast. Also, how do you predict the housing trend for each state? You kind of spoke about it before around looking at salaries to price to income and some of the infrastructure being built and stuff like that.
Cycles are huge ones. Like actual market cycles are a huge one to consider as well, because cycles will if something's at the top of its cycle, it's unaffordable for what it is. But if something looks like it's at the bottom or midway through its cycle, it's how much growth does that potentially have in the tank and what's going to drive the market. So understanding that piece of it, if we talk about cycles, and then understanding what would actually potentially drive that market. Are there massive infrastructure projects coming in? Is there super high population growth? Is there a really constricted supply pipeline in that location as well, and no visibility of it being supplied in time frame as well?
So we've got a stock question. Good news. Bryce, I'm going to ask you, any tips on knowing whether a stock is finished running? E.g., it's had a good week or month, but it still might be compelling.
I mean, no tips on that. I think it's very hard to predict any of these things, but I think the underlying question is maybe when should I be selling if your stock has run? And at the end of the day, we always say only sell if your thesis is broken. I think that's really sort of the crux of it. If you still wholeheartedly believe in the investment, then let your runners win. Far too often we see people...
Let your winners run.
What did I say? Let your runners win, whatever. Let your winners run. Far too often we see people taking cash off the table with their winners to, try and redeploy into something else and then looking back and regretting it. I think Matt's stat is a great example of letting your winners run. There were plenty of times where Meta would have, if it felt like it had an awesome week and you're looking to sell. So unless your thesis is actually broken, then I'd just be sticking in.
Yeah, I mean, to bring it back to an Australian context, I don't know how many people have been following the Drone Shield story recently, but that is a story of a stock that ran so hard and then sold off and people kind of fell out of love with it. And you'd be kicking yourself if you sold because people are certainly in love with it again. And it is just absolutely ripping. So, I think, if the thesis holds, you believe in the stock, you think the management is good, you think they're executing, then let it ride. Do you have a question for us, or you want to?
No, we might go for one more because I know we have a bunch of food and beers available for everyone after, and it'd be great to meet you all as well. So let's just see what we've got up here. Sam, should I sell my PPOR, which is about 2.5 mil?
No, we know what he's going to say here. Come on.
Yes.
I mean, you might be able to give an example around it as well.
Okay.
That's a good question.
And 2.5 mil, well, it's one of the top voted. So 2.5 mil and Rentvest. PPOR is owned outright, no mortgage. How quick can we push it to retire by 2030?
2030, they know APS. I love it. So it's one of those things as well. I think, and that's why I said it's good to read out the question because that was the question I was going to ask was how much debt is actually left on it. The other big thing to weigh into the equation, I won't ask obviously someone in a room of 300 people how much they make, but that actually is a massive part of the equation because if you are on a significant income and you could, so let's say redraw, and if this was the dream home, does it say it's dream home or no? Doesn't say it.
No, not that detailed.
Is it the dream home? Sorry. Dream home? That's not an answer. So it's not anymore. No? Sell it. If it's not the dream home, sell it. If it was the dream home, I'll give you the example. Let's say it's dream home and you loved it and you'd paid it off and you had the ability from an income perspective, you could draw, say, $500,000 or $1 million out of it and use that as working capital if you had the serviceability to do that. And then, again, we could use creative lending to be able to stretch that in a long way and build a portfolio that was going to provide the passive income that you wanted. If it doesn't, sell it. $2.5 million is a ridiculous amount of capital to be able to deploy into the marketplace. The ability to double $2.5 million in a 5 to 10 year window.
All right, I want to end on a more relatable note rather than someone who's fully paid off a $2.5 million house. Although, congratulations, I am very envious of you. I'm going to end on a more for a beginner note. So, for a 20-year-old who wants to start rentvesting, what's a dollar amount where they can start thinking about it as a strategy?
In terms of deposit?
Yeah.
Deposit. So typically right now we're sort of seeing minimum getting into markets like scraping minimum be about 70,000. 80 to 100 is like a very much more of a workable sort of budget to be able to begin with. The beautiful thing about property is you go put $80,000, $100,000 into the correct asset in the correct location. Within a 6-month window, you should be able to pull that $80,000 to $100,000 back out and roll it into another asset and then keep leveraging and building on it. So the first deposit will always be the hardest one to get together, but if you can get that together and then buy the correct asset, that is where the journey will really start. And that's why you should start leveraging and bloody buying property, mate. Nice.
All right, well, everyone, can we give a massive round of applause to Sam? Thank you for sharing your knowledge.
Thanks, guys.
Sam will be around, so all the property questions that we didn't get to, you can ask him in person. Bryce and I will also be around, but Sam will be around, so don't worry about that.
There's plenty of food, plenty of beers. We just want to say a massive thank you for everyone that's come out tonight, that supported the show over the last however long you guys have been listening, engaging through all the content that we do. Without all of you guys, we wouldn't be able to be doing this and having an awesome time up here. So a massive thank you to all of you.
If you've been dragged along here, thank you for coming and tolerating us. Search Equity Mates wherever you consume content. We're there, and we can continue the conversation and keep learning together. So thank you for coming out, and we hope to see you at the next one.
Thanks, guys.
Thanks, guys.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.